This is Pete Moore on Halo Talks NYC. I have the pleasure of bringing a venture capitalist who's going to teach us on how to raise money, when it's the right time to come to a VC, when it's not the right time, and some of his stories along the way. So welcome Kiva Dickinson from Selva Ventures to your first Halo Talks.
Thanks, Pete. Good to be here.
Awesome. So you were at a big fund at one point with TPG, Texas Pacific Group. They're actually investors in Crunch Fitness to one of their funds currently. So why don't you give us a little background on where you started there, what you learned, and why you're doing your own?
Yeah. So I came to TPG via a start in investment banking, was working in the consumer and sponsor coverage group covering TPG's consumer group at Barclays Capital. Eventually joined the team. A woman named Carrie Wheeler hired me after working with her team and really started focusing on the consumer and retail buyout world. Got an amazing training, both what the processes are like at one of the world's best private equity firms, but also, generally the interesting dynamics that were happening in the world of consumer during that time. Really, everything around e-commerce and health and wellness was picking up steam. We were very indexed to retail investing. And I started looking around at the earlier stage and noticing some really interesting opportunities, particularly the better for you products that were making healthier living easier and more fun, that were lining the shelves at places like Whole Foods and Target. That ultimately brought me to a company called Circle Up that was part of that early investing ecosystem of emerging consumer products companies, really supporting companies under $20 million in sales and launching their first $125 million fund to do so in 2017. So I joined them as a partner, helped them get that off the ground. And after 2 years, saw this opportunity for white space a little bit earlier in the ecosystem. Think Circle Up doing Series A through Series C. I was thinking that something in the seed and Series A world within consumer products would be a great place to generate returns and a place that a lot of investors were not focusing. And so I left in 2019 and I started Selva Ventures, which is now 4 years old and about $50 million of AUM.
Gotcha. So, maybe to educate people on the different types of tranches of capital. So you got TPG, which is a later stage growth equity shop, basically saying, hey, you got a real business, you got a platform. Let us help you professionalize that, optimize it, and, get to over 100 or, $500 million type of enterprise value. You go to the Circle Up, which it originally started as more of like a crowdsourcing type of platform, and then kind of evolved into managed circles that were Series A. So the people here thinking about private equity, growth equities, TPG, Circle Up was one of the ways to get capital for, let's say, early stage growth equity. And then what you're doing now is really, more of startup capital and friends and family / Series A. So maybe we can focus on one thing to start, crowdsourcing in general. There's not a lot of governance and compliance on behalf of investors because you've got thousands of investors going into a company. What did you see at Circle Up that basically allowed you to say, hey, look, these are good investments. If we can put a manager or a principal on top of that investment to basically govern it, if you will, how did that help or hurt, the dynamics of that platform?
Yeah, Circle Up had started, to your point, as a crowdfunding platform to just simply connect investors with companies.
Right.
And facilitating a transaction often meant anywhere from, a single investor that would negotiate terms and join the board to a wide range of angel investors looking to just have an easy way to put money into a company. What Circle Up did really well was find some of the best companies within the emerging consumer products world. Think Halo Top, Beyond Meat, Simple Mills, all really great outcomes. What they didn't always have is that clarity on the investor side. And that ultimately led to a place where in 2017, they wanted to raise their own fund. Say,
Right.
rather than leave it up to investors to, join the syndicates and ultimately invest in these companies, we should actually raise our own pool of capital, manage it ourselves. And that's where I came in. That's where I left TPG to help them with that effort. I mean, no doubt, identifying the companies is incredibly important, but building a tight investment process, both pre and post investment, not only to select the right ones, but also to support them afterwards, to have a value creation plan that ultimately helps these companies reach their potential. It's a huge part of private investing.
Yeah. Yeah. So when you take a look at what you're doing now, obviously you had Circle Up, quote unquote, on your resume. TPG, kind of late stage investing. So when you started up this fund, were you doing deal by deal? Did you actually raise, $50 million fund out of the gate just to give us this insight? Also, I think entrepreneurs that are looking to take capital from venture firms and take capital from private equity don't necessarily understand how hard it is to actually, for you to get the money, for them to invest in them. So give us a little window into that.
Yeah, happy to talk about that. So I think in terms of the start, I wanted a committed pool of capital that would ensure that when we showed up to an entrepreneur to invest in that company and said, we want to invest, call it $500,000, $1 million at these terms, that we had the money lined up, that we were good for it. Because, oftentimes an entrepreneur will accept a term sheet from an investor. Maybe they're going deal by deal. That investor doesn't have the money yet. And that can create a lot of turbulence in the fundraising ecosystem. So I wanted to raise a committed fund that would allow us to have that flexibility and also have that diversification. And that meant starting small with what I viewed as like a proof of concept. Essentially, let's go raise $10 million that will show that this strategy works, that it's interesting, that not only will there be strong outperforming returns at this stage, but that the best companies will actually want to gravitate towards us, that they like what we have to offer. And so that first fund ended up being about $10 million. We raised it between mid-2019 and the beginning of 2020. And, that fund ultimately got deployed into 14 companies and was the kind of platform for us raising our second fund, which closed about a month and a half ago and ended up landing at $34 million. In terms of difficulty to raise it, I mean, look, it's probably the biggest challenge in fundraising for a fund in general is, if you're an entrepreneur that goes to an investor, you have a very distinct business idea that investor is evaluating. They're evaluating your the market that you're selling into, your market positioning, the differentiation of your product, your experience. When somebody invests in our fund, they're believing that we're going to deploy that into 10 to 15 companies that they don't know about yet, and that they're going to do so effectively. So they call that a blind pool. And with that comes much tougher evaluation oftentimes of our process, which can feel kind of amorphous. And so, it's not easy to raise that capital at the beginning. It's a super rewarding process when you form those relationships with LPs who do back you. But have a lot of gratitude for the faith those folks put in us.
So just for our listeners here, you raise a dedicated venture firm and you raise $34 million. Basically, when Kiva sends out either an email or a notice that, hey, we're funding this company, it's closing, on August 31, you fund your allocation. It's not something you decide if you like the company, don't like the company. Like, you're funding, you're obligated to fund that allocation. And that gives him and his team the ability to go and have a certainty of closing, versus an independent sponsor. And I kind of joke around, Kiva, that, the only thing independent about sponsors that don't have capital is that they're dependent upon capital. So they should actually be called dependent sponsors. But you're past that category now. So welcome to the big show. As you look at deals and the amount of transactions that you could potentially do a year, I used to work in a private equity fund down in Florida. We had 300 deals that came in. We had 12 LOIs and we closed on 2 deals. So give us a view of your early stage funnel, if you will.
Sure. Yeah, we did this math last year when we were fundraising that kind of back to the origination of the firm. On average in a year, we see about 1,000 new companies. We actually talk to about 300 of them. So, roughly one new company, one new opportunity per day of the week. And or per day of the year. And then we ultimately invest in somewhere between 3 and 5 of those. And so the funnel goes down pretty steep. And what we find over time is hopefully that number that we can talk to, that 300 number per person, gets smaller as we get more focused and we get more clarity on what we want to see. We hope that 1,000 gets larger because that means the venture ecosystem is growing and we get calibrated. But all those companies that we talk to that we ultimately don't invest in are really helpful for us, not only to ensure we're seeing the right things, but they're also a great source of ideas. I mean, many of the themes that I have the most conviction on for the future came from entrepreneurs convincing me through their dedication of their life's work that there is a problem worth solving that hasn't been solved yet. And so
Right.
oftentimes something that we pass on this year may be something that we invest in next year or the year after.
Yeah, I think that's one really interesting point. And we've made 7 early stage investments through Integrity Square. We're not making any new investments because it really takes a team to help manage through companies and help grow them and provide significant value, I think is important. I kind of thought 11 years ago when I turned 40 that I was going to bat 1,000 on every deal. So that didn't happen. I decided, okay, maybe it's not the best use of my time. Let me go and deliver these deals to potential VCs that can actually drive the business. You talk about the one thing I always look for in a new business that comes to us and kind of shepherd them on is what frustration are you solving and who are you solving it for and how did that become a frustration you knew about? So I feel like the best ideas are people that are solving frustrations, maybe for themselves. And
Yeah.
and then they get to a point where, okay, this is actually a business. It actually has a revenue model. So how do you kind of nicely either say to somebody, hey, look, your frustration you've solved. I love it. Maybe you need to tweak the business model or the revenue model, or maybe you're not thinking about it the way I would think you could optimize it. But if you come to me with, to give you an example, like Soul Cycle meets aerial yoga, meets an elliptical bike, in a EDM, rave environment. Like, I don't know if did something happen that you got amazing results out of that, or are you just kind of pulling like 4 things in together and trying to turn it into a business stew?
Yeah. I mean, at the end of the day, the first question that we ask the companies that we talk to, and the first thing that is written on every investment memo we write is just why. There's
Yeah.
so many things out there. Like, why are you doing this? What is the problem? What we call it. We have 5 M's that our memo breaks down, and the first one is matter. Why does this problem matter to the consumer? Because we fundamentally believe there's lots of cool things out there,
Right.
and cool things are a great path to a niche or a fad. But it is the problems that get solved for consumers that consumers like to talk about with one another, and that ultimately breeds organic growth. So we need to see the results, the traction that we're ultimately investing behind is being deeply connected to that problem being solved for the consumer.
Got it. When you take a look at every hockey stick projection that is put, perfectly aligned in a 45-degree angle on revenue and EBITDA of an early stage company, what are some of the things that you invite? Let's say you're going to make an investment and you come to a terms on valuation. Maybe talk about, even if it's $1 billion opportunity or a multi-billion dollar opportunity, you're still a company that's got 500 grand of revenue. You got competitors. There's probably not a patent on this. So this is kind of how I'm thinking about what I'm bringing to the table and what my money is worth. Not necessarily like, all right, you're going to crush it. You're the only horse in the race. I say, I think you're going to create a $500 million company. Well, let me just kind of hit the pause button for you, sir or ma'am. And let me tell you how like the real world works and how this roller coaster ride is probably going to go down. Not sure if there's a question there, but go ahead.
We don't like to lecture them so much as have them have thought about how hard this is going to be and the nature of urgency. So you're right, there's very little moat to a consumer product. We think the moat typically is the real estate that you own in the mind of the consumer. When I say spin class dance party, you immediately think Soul Cycle. And
Correct.
so like that same thing happens everywhere across the grocery store. I could trade refrigerated protein bar, you'd probably think of Perfect Bar. So that is a first mover advantage that you have to roll with and invest behind and make sure that the other competition doesn't catch up. The second moat you have is real estate on shelf, because a retailer is not going to have 50 versions of everything. They're only going to have a few. And so that first mover advantage needs to get built on. When you're solving a problem for the consumer, you need to move faster than your competition. So we believe in that fundamentally. But the hockey stick projection really is just one imprecise look at the many variabilities of how the world might work. We get a lot more excited once we see a big opportunity to start talking about things at the unit level, meaning what does it cost to acquire a customer? What do you get from that customer in terms of gross product and average order value? How likely is that customer to come back? How often will they come back? How quickly do you pay back your advertising spend? This could be offline or online, by the way. And what will that ultimately turn into in a metric of either LTV to CAC, lifetime value to customer acquisition cost, or more generally in a business sense, return on invested capital? For every dollar you invest in growing your business, how much do you get return? The best correlation to company valuation that I've ever found is return on invested capital.
Got it. We were in what we call the halo sector, health, active, lifestyle, outdoors, which encompasses better for you food and drinks, better for you lifestyle choices, destinations, what have you. Brands are super important, and brands do make a promise and come through on delivering on that promise. Now, we as an example, we're an investor in a company called Higher Dose, which is an infrared sauna mat. It went all e-commerce, doing great. They've got a brand promise. They're starting to do some things on the beauty side that might be more recurring. So when you take a look at a company and you take a look at a founder, and they're doing $250,000 or $500,000 of revenue, how do you and your team kind of like look out into the future and say, hey, this is kind of like the Cliff Bar of like training? Or how do you look at a company and say, oh, this is like the next vitamin water if these things are done properly? How do you I'm sure that a lot of people come to you like you've probably got 100 water related concepts and like drinks, and like you can say, okay, I can taste it. It tastes good or it tastes like shit. And I'm not sure if some people realize how bad some of these things taste. When they go to market with them. So how do you kind of like look through and say, okay, I like the sector, I like the category. Not sure I love where they're positioned right now. They might not be the first mover, but there's some DNA to this or not.
Yeah, I think there's two pieces to it. The first is we get maniacally focused on value proposition to the customer. Really understanding, again, what's the problem the customer is solving? Who is the customer? Why does this solve the problem? How does that compare to what else is out there? How wide a group of people could this appeal to? And then the second is, if you're looking for the next vitamin water or the next Cliff Bar, you should know a hell of a lot about what vitamin water and Cliff Bar's journeys were like.
Sure.
You're trying to map a pattern. And so we do a lot of studying of what brands came before that really worked or didn't work in order to try to match those patterns. I think that's something that a lot of folks are reluctant to dig into, frankly, is like going back in time and trying to figure out what is the pattern that would have worked. What is the process that you could have flown RX Bar, Cliff Bar, Vitamin Water, Body Armor through that would have told you to invest at the time that you're investing in now in the next one?
Right. So you got that. So you're going to put that on the net for us or what? I was just kidding.
We've talked about it openly, man. Seriously.
Yeah.
I've posted on Twitter about it. We call it the 5 M's. It's a method of evaluating matter. What's the problem and why does it matter to the consumer? Mega trend. What is the ultimate rising tide within consumer behavior that we think is like decade plus that's ultimately going to, have you invest behind a trend that's going to be bigger when you exit than when you invest? Management. What's the strength of the team? Why is this a group that you should be betting on? Momentum or metrics, meaning like what traction have they proven? How capital efficient could it be? And then market. Why is it big enough to matter? The way that we evaluate each of those things in the context that we flow it through, we're not going to post on the net. But ultimately, we've tried to figure out a bit more of a quantitative way to evaluate all of these opportunities against one another.
That's great. That's great. So for those of you that are doing your SWOT analysis, maybe you can go with the 5 M's and then bring ideas to Kiva.
I recommend it.
So let me ask you one more question here two questions before we break on our first one. One is, what is the ideal size and makeup of a company that would fit into your, out of the 300, you might talk to 100, or you talk, what kind of, accolades do you want to see, or momentum? And then the follow-up question to that is, when do you know it's time to sell one of these companies? Obviously, you got a company that could be on fire, and you might say, hey, look, we might be giving up some of the future upside, but, our goal is basically taking them from here to there. And then our investors know we're going to monetize that and realize the return.
Right.
And kind of let the next group kind of take it from there. So two-part final question.
Yeah. Size, we're not so focused on an exact revenue threshold or an exact moment in time. We want to invest once there's sufficient proof that you're solving a problem we're solving and that you're the one to back, and not so late that we can't generate a venture return.
Okay.
So that means probably the prototypical deal for us is investing in a company that's doing about $5 million in last 12 months sales and growing very quickly.
Got it.
In terms of when to exit, it's probably more a function of what the founder views as the right time for them and what the market bears in terms of strategic and private equity acquirers viewing it as big enough to warrant an investment, but not so big that there isn't value left for them.
Sure.
So we underwrite every single one of our investment opportunities to an exit at an enterprise value between $1 and $300 million. Pretty rare for a venture capital fund. Usually venture capital funds are underwriting to like $1 billion plus. And we feel like that leaves a lot more upside for the next acquirer, or upside in our model for really outsized outliers that every now and then you'll run into without breaking the return model that our investors rely on.
Got it. Okay, and then I do have a last question. Where does the name Selva come from?
Yeah, it's a Spanish word for rainforest. We wanted to connect to something that would embody our value of not just healthy living, but incubating and supporting ecosystems that bring about healthy solutions. So rainforests are the largest incubator of life and natural medicines in the world. They're an incredibly powerful ecosystem. They also have this cool ecosystem dynamic of having 4 layers. You usually see the 3rd layer, that canopy that sees dense layer of trees whenever you see an overhead shot of a rainforest. There's 2 layers underneath, which is where a lot of the animals live. There's a 4th layer that people don't know about, which is like a 1 in 1,000 tree that rises above the canopy called the emergent layer. That's the one that we're looking for. Those 1 in 1,000 opportunities that are really special that rise above the rest. And it's denoted actually in our logo, the blue stem. It looks kind of like a leaf, but the stem of the leaf is actually a tree that's rising above those 3 green lines, which are the other 3 layers of the rainforest.
Nice. All right, I'm glad I asked that. Well, welcome officially to the Halo sector. So if you want to take the rainforest, put it into the Halo sector, health, active, lifestyle, outdoors, you'll be our go-to VC group for early stage entrepreneurs that come to us. And this is a good tutorial on the 5 M's and how to think about VC, and also how to think about the right timing and, how the way you think is important, because, whether you take a minority stake or majority stake in a business, you're going to be there helping them, take it to the next level, or go through the forest and go through the ocean, with them. So thanks for jumping on and for, focusing on helping us get to the next level of Halo entrepreneurs and companies.
Of course. Love the mission of what you guys are doing and excited to support it. Thanks for having me on.
You got it.